Brad Williams, Frugal Finance, volatility, market volatility, stock market volatility, investor tips for turbulent markets and volatility. Volatile markets can inspire feelings of fear and anxiety among investors. Market surges and sell-offs can occur for any number of reasons, including political factors, inflation fears, trade policy concerns, tax breaks, economic optimism or pessimism, global events, or a recession watch. When the stock market gets rocky, focusing on your overall financial picture, combined with sound planning, pay dividends. These 5 steps can help steady your pulse during turbulent markets and elevate your financial security. Clarify your financial goals. Solid financial goals tied to a sound long-term financial plan typically will survive short-term market ups and downs, and they can help you weather market volatility, whatever the cause. If you don't yet have clear, prioritized goals, each with steps to achieve the goals, a price tag, and a time frame, take a break and set them to help your investment approach. In other words, if you own a portfolio of growth stocks in a volatile market, expect, indicator we look at is beta. Your overall beta in a market portfolio is 2.0. Well, your goal says you like aggressiveness and anticipate severe volatility. That means if the market hypothetically dropped 1,000 points, your portfolio could drop 2,000 points. Now, I know that's extreme, but you get the idea. Your stock portfolio is going to move twice as much as the market index. If you anticipate continued volatility, perhaps you might want to rebalance your portfolio. Diversify your assets when you have a large portion of your holdings in a particular investment, asset class, or market segment relative to your overall portfolio. You expose yourself to concentration risk. This can amplify your potential losses from a significant market movement. It's important to diversify across and within the major asset classes. Do you hold multiple asset classes such as stocks, bonds, and cash? Are your stock holdings spread across different sectors? Biotech, electronics, consumer staples, and emerging markets, to name a few. Is your bond portfolio diversified by issuer and type of bond, corporate, munis, or treasury? Diversification, that's what this is all about. Take a long-term approach, perhaps rebalance a little bit, but in the long run, 20, 30 years, what happens today is a hiccup in the long-term scheme of things. Focus on your future. Avoid impulse decisions when markets become volatile or economic conditions change. Instead, go back to step 1. Be aware that strategies such as dollar cost averaging can help you stay focused on your future. Dollar cost averaging involves investing your money in equal portions at regular intervals rather than all at once or automating deposits to investment accounts. This can reduce or remove emotions from decision making and supports continued investing regardless of the existing market conditions. The only way this works, it has to be automatic. You will not pull the trigger in a down market, or you won't pull the trigger in an extreme up market. That's why it has to be automated. You cannot bring your emotions into play if you're doing dollar cost averaging. So set that up so it's an automatic thing. You don't even go back and think about it too terribly much other than to review your monthly broker statement. Understand the impact of changing interest rates. When stock markets are volatile, demand for fixed income products often rises, which in turn can drive up prices and depress yields. When interest rates eventually rise again, bond prices generally fall. But interest rate risk isn't the only factor to consider when you invest in bonds and other fixed income products like bond mutual funds or exchange traded products. For example, duration risk, which is the risk associated with the sensitivity of a bond's price to a change in interest rates, is another factor to keep in mind. Research the risks of investment products and strive for a balance of assets to minimize the effects of interest rate changes on your entire portfolio. Now, keep in mind, if you are investing for the long term and you hold long-term bond, you don't care about duration risk. You don't care whether the market or bond prices move up or down. You're not out there calculating yield to maturity on an ongoing basis. This is like a long-term hold with your stock portfolio. Unless you're trading bonds, fixed income securities, don't put too much stress on this. Protect your money. Fraud is a growing threat, and financial scammers operate in all market conditions. In times of high market volatility, investors may be particularly vulnerable to pitches touting guarantees of risk-free returns. Combining a guarantee with a specific amount of money you will make, this is a safe investment that will earn you $6,000 every quarter, is known as phantom riches. Reduce the likelihood of fraud by working only with registered investment professionals using FINRA's broker check. Right up here, you see where it says broker check? Check it out. And to find out if a person is registered to sell securities by sticking to your predetermined financial plans. Stock market fluctuations are outside your control, so control what you can and focus on key investing concepts such as asset allocation and diversification to make your investments remain aligned with your goals. I have countless videos on asset allocation, investing, scams. Check out my YouTube playlist for an ongoing portfolio of interesting investing videos. This article will be posted below. Comment, Brad Williams. Frugal Finance. Hope that helped. Thanks for watching. See you soon.